Lucky enough to start with Rhian Saunsbury from IAG. She's going to take us through the overview of the standard to get us started with at least the right overview and the right lingo to begin. Rhian.
It's quite tricky. You can't actually see the slides from here. That's all right. Oh, they're done. Thank you. Yeah, thanks. So good morning, thank you for having me. My name's Rhian Saunsbury. I'm from Insurance Australia Group, or IAG. I get the lucky pleasure to introduce you to IFRS 17 today. So many of you would probably wondering, what is IFRS 17? So IFRS 17 is the new accounting standard issued by the International Accounting Standards Board for insurance contracts that was issued back in 18th of May 2017. This was subsequently, shortly afterwards, adopted by the Australian Accounting Standard Board from July 2017 with largely almost exactly the same wording. So you'll find throughout the conference over the next few days that people use these words interchangeably, IFRS 17 and AASB 17. So the standard currently is effective from 1 January 2022, but as when I go through the next slide, I'll explain to you how that date may be subject to change. The purpose of IFRS 17 is really to bring global consistency across reporting across the world, particularly in those countries where IFRS is adopted. So that's 186 countries around the world. IFRS 17, when it becomes effective, will replace the current accounting standards that we have in place today. So that's IFRS 4 internationally, or AASB 1023 for general insurance contracts, or 1038 for life insurance contracts. So I thought it would be helpful just to start with the journey that the standard has been on to get to where we are today. So the insurance contracts project started back in 1997. Now, I imagine quite a few of you in the room, similar to me, hadn't even thought about a career insurance at that stage. The first major milestone along that journey was the implementation of IFRS 4, so that it was issued back in 2004. Subsequently to that, then IFRS standards were adopted in Europe in 2005, so we started to see some consistency coming through in the global reporting. Bear in mind that we're quite lucky in Australia that we had quite advanced insurance accounting back in the mid-90s. Those standards were then subsequently changed to take into account the changes that were coming through IFRS 4 around the same time. So since 2004, when IFRS 4 was issued, back to May 2017, there were a number of exposure drafts that were issued throughout that period of time, where the industry were, welcome to offer comments to make sure that that standard was as complete as possible. Then we saw in May 2017, the IFRS 17 standard was finally issued. Following that issuance of the standard, the ISB staff put together a group of individuals called the Transition Resource Group, or TRG, the purpose of which was to discuss issues that individuals or companies within the industry brought forward and how the standard might actually be applied in practice. Those TRGs have run since February 2018 till most recently April 2019, with potentially more to come, where they had gone through and discussed those issues that had been brought forward. Those issues then, the number ones that got fleshed out, it felt there was a need to make some further amendments to the standard. And therefore, in June 2019, so 30 June this year, we saw a new exposure draft that was issued. This then was followed by a comment period up to the 30th of September, where people within industry, companies, Big Four, were welcome to provide comments. So a number of players within the industry, including IAG, fed into the AASB's process, and we, as a combined body, issued our comments to the ISB board, along with a number of others, including IAG ourselves. We issued our own comment letter for the issues that were particularly pertinent for us. The ISB staff have then summarised the main key themes coming out of those comment letters, and then have put those proposals towards the ISB board. That happened last week. The ISB board then came forward and have said that they will consider 13 of those issues that have been raised for further consideration as to whether any further changes are required. One of those issues is the effective date of the standard. So while I said it's due to start in January 2022, that is subject to change, but hopefully we should find out more in mid-2020. The other thing probably to note that I haven't actually put on this timeline is what APRA have been doing. So APRA issued their indicative ideas back in 30th of September this year. So that is so that comment closed. So that was a paper open to the industry for comments, giving their indicative direction of how they think the capital standards may change or not, as we will see. That also was accompanied with a survey that was issued to the industry, which I'm sure many of you in the room have participated in. So I guess just to summarise from the beginning, what is IFRS 17 really trying to achieve? It really is around that global consistency and global reporting across all those different insurance industries. So it's one standard for general insurance, life insurance, health, and reinsurance. The purpose as well was to allow some investors to more easily be able to compare across those different industries, but also across other industries within, across different companies. So allowing investors to be able to compare insurance, life, general and health, and also those with outside that sector. So it introduces P&L items that are more familiar to those. For example, insurance revenue, that allows more comparability. The IFRS, the standard actually also introduces a much more detailed level of granularity of information to be provided to the market. There's also enhanced disclosures around current and future profitability, which obviously allows the investors to get a bit more of an idea of what to expect going forward. There is also some consistency in IFRS 17 as compared to other standards that have been recently issued, for example, IFRS 9 and IFRS 15, whereas IFRS 9 brought the idea of bringing forward those expected credit losses on banking products. You have some similar concepts coming through in IFRS 17 around that early recognition of losses. Whilst I appreciate that we already have the LAT test under the current regime, this is the early recognition of losses is now going to be on a much more granular level and also on a gross level, so you can't take that benefit of reinsurance into account. That's based on the current wording, which is subject to change. So I guess what are we accounting for under IFRS 17? Well, firstly, you need to identify the contract that you're looking at. You need to understand what is the service that's been provided, how long is that contract, what are the performance criteria, and are there any cancellation clauses or extension options. Then you need to understand whether it meets the definition of an insurance contract under IFRS 17. The actual definition under IFRS 17 hasn't significantly changed from what you have under IFRS 4, 1023, 1038. The key change is around financial guarantees, where you have an option to apply either IFRS 9 or IFRS 17. So that's a bit easier than it may seem. You also need to consider whether there are any distinct embedded derivatives, investment or service components that maybe should be separated from that contract and measured under IFRS 9 or IFRS 15. If they're not, so distinct would be where they're not highly, then those components are not highly interrelated with other components and could be sold separately. If they're not distinct, then you keep them together and measure the whole contract under IFRS 17. So I think it would be good to just summarize what are the key highlights of things that have stayed the same and what has changed under the standard. Now, just to note as well, there will be a lot more detail into these concepts over the next few days. So what has changed? IFRS 17 is a standard for measuring insurance contracts. It's not necessarily for insurance entities. That's one key change. The IFRS 17 obviously is for, like I mentioned, it's for life, general, health, and reinsurance. There are lots of differences in those products that are offered between those different types of industries. And therefore, IFRS 17 introduces 3 measurement models, the key one being the general measurement model. There is then a simplification of the general measurement model called the premium allocation approach, or PAA, and then is also referred to as the simplified approach. And then you have, for participating contracts, the variable fee approach, or VFA. Now, like I said, I'm from a general insurance background, so I'm not going to talk too much to the VFA today, but there is a life insurance breakout session, I think later today or tomorrow, where that will go into more detail on that one. Now, looking at the PAA, in terms of what's the same, there's some very similar concepts under the PAA to how we measure general insurance contracts currently. When you're measuring your insurance contract under the PAA, it introduces a thing called the insurance contract liability. That's comprised of the liability for remaining coverage and a liability for incurred claims. The liability for remaining coverage is quite similar to the concept of bringing your DAC and your UPR balances together. The liability for incurred claims is not that dissimilar from the idea of your outstanding claims. The reserving concepts are quite similar. There are, however, some nuances in how you do that. Further, the general model is it's an expected cash flow model, so you're projecting what your probability-weighted expected cash flows are within that contract boundary. The net of those will give you what's referred to as a contractual service margin, or CSM. That's not that dissimilar from a profit margin, with the idea of margin on services not being that different from what you're looking at under the general model. As I already mentioned as well, the definitions of what is an insurance contract under IFRS 17 is not that different from what you see currently. And further, as I quite often mention in my role at IAG, the general economics of those underlying insurance contracts and reinsurance contracts haven't changed. It's still the same contract. You're still going to be paying premiums to your reinsurer. You're still going to get recoveries from that reinsurer. It's just the timing of when they might hit your P&L that has changed. In terms of what has changed, so in terms of your presentation and measurement of your directly issued insurance contracts and the reinsurance contracts you might hold against those, they now need to be separated and measured separately. So what that means is you really need to take into account what are those rights and obligations under those contracts separately. And then they will be presented separately on your balance sheet and P&L as well. The other thing to note is the concept of risk margin or risk adjustment. So for general insurers, we've already had the concept of risk margin for some time. This is a new concept for people in life insurance, so it's something for them to think about. Further, the wording behind the definitions of risk margin and risk adjustment are quite different. So a risk adjustment is the compensation that an entity requires for taking on that risk, for issuing that contract. Whereas a risk margin is really there to reflect the inherent uncertainty in that central estimate that you've reserved for. So if I wanted to be, for example, 75% accurate in my reserving, I'd add on a margin to my central estimate currently. The change in those definitions actually can lead you to have a different approach to how you might reserve those. The other thing to note as well is that discount rates, currently we are allowed to discount our outstanding claims liabilities at risk-free. Going forward, we need to apply what's referred to as an illiquidity premium. That illiquidity premium really reflects the fact that our insurance contract liabilities aren't risk-free. We couldn't settle them tomorrow necessarily, and therefore that illiquidity premium reflects that difference. The other thing to note as well is that around aggregation. We're no longer aggregating our balance sheet necessarily at an entity level. Going forward, the level of aggregation is determined by management, being the level at which you have similar risks and you manage those contracts together. This is also by what's referred to as annual cohort, or also could be as underwriting year. So what that means is if you are writing multi-year business, maybe in 2018 and 2019, you wouldn't necessarily be allowed to aggregate those two together if they had different profitability profiles. The other thing as well to note as well that the standard also introduces significant increase in disclosure requirements on both the gross and reinsurance contracts separately. This has quite a lot of change, particularly if you're looking in your processes and designs as how you might get that data to flow through. So I mentioned this already, but I thought I'd just do some high-level introduction into those measurement models that you'll see today and tomorrow. So like I said, under all the measurement models, they introduce this idea of measuring an insurance contract liability on that insurance contract that you've written. It's comprised of the liability for remaining coverage and the liability for incurred claims. The liability for remaining coverage is really around the obligation that relates to that unexpired portion of coverage or future service. The liability for incurred claim is the obligation that the entity has to investigate any incurred claims or any outstanding claims that has not yet settled, or in other words, past service. So the diagram on the screen here is really a construct of what your liability for remaining coverage is if you were from initial recognition to that first reporting period. So on the left of the screen, you have the premiums received. So note the word received. It's not receivable. That's a key change in the standard. We're talking about cash flows now. So it's premiums received that you've received up front potentially. Your expenses paid, so this could be commissions paid to a broker, for example. You then would earn some of that premium, so that would be reflected as insurance revenue, and then you would have your insurance service expense, which is those amortized expenses that you've paid. The net of that would give you the liability for remaining coverage, and this is how it would be constructed under the premium allocation approach. The liability for remaining coverage on the general measurement model is slightly different. As I mentioned earlier, it's really around looking at what are those probability expected cash flows that you expect within that contract boundary. So you need to think about what are all those expected premiums, claims, should I flick through? Premiums, claims, expenses, I don't know, can you see the slides? Are they gone? Where was I? Here. Yeah, right, sorry. So yeah, those future premiums, claims and expenses that you expect during that contract term or boundary, and then they would be discounted back to time zero, and then have a risk adjustment reflecting that compensation that you require for taking on that risk. That's potentially based on your management's risk appetite. The net of those cash flows will give you your contractual service margin, the CSM. Also could be construed as your profit margin. Then at time that would give you your initial recognition. Now if that CSM is positive, the net liability would be zero on initial recognition. So your balance sheet for your insurance contract liability on your balance sheet at time zero would be zero. If that CSM is negative, that would be your loss component that you would recognize upfront in your P&L, and you'd have a corresponding liability for that amount. Then if we go similarly from time zero to the first reporting period, similarly to under the PAA, you'd have some cash received for the premium you've received, some cash paid for expenses, for example, those upfront commissions paid to the broker. You then amortize that CSM this time to give you your insurance revenue. You'd amortize some of those acquisition expenses to give you your insurance service expense. There would be some discounting unwind to reflect that movement in the time. and then the net of those balances will give you a liability for remaining coverage. The liability for incurred claims is consistent measurement under both the general model and the PAA. What you would do is start with, similarly today, your central estimate of what you expect those outstanding claims would be. So that could be comprised of if an event had occurred, that would include your IBNR, those incurred but not yet reported, as well as any outstanding claims that you've been notified but have not yet paid. You then can take into account any non-reinsurance recoveries. So this could be any salvage or subrogation that you may get. Note, this is not including any reinsurance recoveries. Those would be measured separately. You then have some discounting on that. Now that discounting, as I mentioned earlier, will include that illiquidity premium on both the liability for incurred claims and the liability for remaining coverage. You then apply a risk adjustment to reflect that uncertainty and the compensation that you need for those, and the net of that will give you liability for incurred claims. The combination of the two, the liability for incurred claims plus the liability for remaining coverage, will give you your insurance contract liability on the balance sheet at the end of the reporting period. So that's really all I had to speak to you today in terms of an introductory perspective, but I'd thank you for having me today, and I'd welcome any questions.
If we pull up the Slido, you'll see there's been some interesting questions which have come through. It's a pretty tough audience. They're already asking you some hard ones, so they're not letting you get away easily. So first question, why is Jeff such a good MC? So I don't know who posted that anonymous question, but look, I suppose I won't let you answer that, but that's all right. The second one really is more just an information update, which I actually forgot to give, which is that if you looked in your Lanyons, there is a mini program. So if you want to look ahead as to what else there is during the day, today and tomorrow, you've also got that little slip in there. So is there anyone else who didn't feel like they wanted to post a tough question on Slido and feels like they would like to ask it now? Yeah, I thought it was a great overview. I'm quite a graphical guy, so I quite like the fact that there's the elements split down. It definitely does mean that really it seems as though it's an accounting standard which doesn't seem as though accountants alone are able to implement it, given the transformative nature across the business. So I'm sure we'll hear more about that from other speakers.
Okay.
Thank you. I've got a small token of appreciation from the FSAA for doing the presentation this morning. Thank you.
Thank you.